All right, so let's go ahead and take a look at 13.5. This is the section where we're going to look at stocks, bonds, and mutual funds. Okay, so there's some special terminology and some special formulas in here that we'll take a look at. All right, so stocks are these financial vehicles where you actually purchase a piece of the company, a small piece of the company. It's called a share in the company. And so if the company makes a profit, then you get a piece of that profit, and that's called a dividend. Gotta spell it right, dividend. Okay, let me get my color to be consistent here. We do blue. Okay, it's called a dividend. All right, now, the profit you make by selling your stock for more than you paid, that's called a capital gain. And you may hear that terminology if you listen to the radio, to the news, and that sort of thing. And sometimes you sell stock and you don't gain, it's really negative, so it's really a loss. It would be called a capital loss. Capital is like the stock itself, and then you might have a loss or a gain when you sell it, if you sell it for less than you paid for it. All right, and then return on an investment. By return on your investment. Okay, that's the difference between what you receive, including dividends, and what you paid, which would be the purchase price and if there were other expenses like broker commissions and that sort of thing. All right, so it's like the net amount you made on that stock. Right, and then the price of the stock is determined by supply and demand. And there's a lot of different stock exchanges. You might have heard things like NASDAQ, things like that. Okay, these stock exchanges determine what the value of the stock turns out to be based on the buying and selling that goes on with these stocks. Okay. All right, so let's try a problem where we're just trying to calculate our return on our investment. All right, so in this problem, the information we have is that we bought 100 shares of this stock in this company. We paid $28.50 a share, okay? And then a year later, we got a dividend of 60 cents per share, and the stock price was now $29.75. So your total cost for the stock would have been the $28.50 per share times the number of shares. So that would be $2,850. All right, now your dividend amount was 60 cents per share. So take that 60 cents times those 100 shares, and that would be $60 you earned as a dividend. Okay. Now, if you sold your stock, you'd receive $29.75 for every one of those 100 shares. So you would receive $2,975. But that's not your capital gain, right? That's just the amount you would receive if you sold the stock. What you do for capital gain is take that amount and subtract how much it cost you. Okay, so take that, subtract the amount it cost you in the beginning, and that turns out to be $125. So that $125, that would be your capital gain. Okay, this right here is your capital gain. So your total return would be the capital gains together with those dividends that you earned, that your share of the profit are those dividends, and that would turn out to be $185. Okay? So that's your total return on your investment. Now, sometimes it's good to look at that as a percentage. Okay? So that $185 you earned was on that 100 shares of stock, and they were valued at 2,850. So you could do that, and that would turn out to be about 6.5% of a return on your investment. So they don't really give you any kind of formula here. You don't really need it. You just have to think logically about it. But you do have to understand capital gain is the amount you make when you sell your stock, so, and then subtract from that the cost of the stock. Okay, those two things. And then total return is both your capital gains right here plus your dividend. Okay. All right. Now, let's do a little more with stocks. This used to be in the newspaper. I haven't noticed that lately. Newspapers have kind of gone out of favor. You can still get all this stuff online, but this is what a stock table looks like. So it has the name of the stock, and it'll usually have a symbol that's used to represent it that's unique to that company. And then there's all sorts of information in there. And you don't have to memorize this, but you just have to have the gist of what these different pieces are. Okay. So with this one, the 3.5 is just telling you that the stock has increased 3.5% so far. Year to date is what YTD stands for, is year to date. Year to date change, percent change. Then you can imagine 52 high and low would be the highest and lowest price in the last 52 weeks. Then over here under the yield area, this is telling you that the dividend would be 53 cents a share. Now that 2.8 came from the percentage form of that. So if you take 53 cents and divide it by the value of your stock, $18.79, you'll get 2.8. Okay. So somebody just calculated these things for you. So we can take the 53-cent dividend and divide it by the $18.79, and that's where that 2.8 comes from. Okay, and then the price to earnings ratio is getting the stock price. Okay, and then dividing that by the earnings per share. So that's taken the $18.79. So to get this number, they really took the $18.79 divided by the 53 cents per share. That's where the 35 came from. It's actually 35.45. Okay, but you'll just read that, take that out of the table, and you just have to know PE means price to earnings ratio. Right? And then the next one is telling you the share, how many shares of the stock were sold that day. And it's not just 1,411, it's that many hundreds. See how it has hundreds here? So it's 141,100 shares were sold that day. Right? And this was the closing price of the stock that day. And then here, since it's positive, it's telling you that it was 3 cents higher than yesterday. Okay? So you have several problems in homework that ask different questions related to the stock table. All right, so let's go on now and talk about some other things. So sometimes you need somebody's help to determine what stock to buy or what would be best for you to do. And there are full service brokers, and then there are discount brokers. And the full service ones, they often make recommendations based on what they know about you, like what risk you don't mind having and how much money you have, and also your age, like how long is it before you retire, that sort of thing. Then there are brokers that maybe don't provide as much information to you. They probably don't make a specific recommendation, and so they may charge less for their services. Okay. And so these brokerage firms are going to charge you some kind of a commission. It's a fee, broker's fee, for buying or selling a stock. Okay. And they're typically going to be some kind of a percentage of the value of the stock you're buying or selling, like the total amount you're buying or selling. Could be like 1 or 2%. And then there may be other fees, like if you do multiples of 100 shares versus maybe odd things, like maybe you want like 12 shares. It's not a nice round number. You might have to pay a little more per share. Okay, so this table, you'll see tables like this in the homework, might be a typical commission structure, whether you're doing it, the stock trade by phone or online, okay, or whether you have an actual person assisting you with it, okay? All right, now let's go ahead and talk a little bit about bonds. With bonds, what you're doing is it's like you're loaning money to a company, and then they'll pay you interest for that money. So cities a lot of times do this. You can buy a municipal bond where you put money, you give the city money to use to do whatever they're trying to do, and then they are going to give you some sort of interest on that money. Okay. All right. So you may lend money to a company and then get a certain interest rate for the use of your money. So it's still called, they refer to it that you bought a bond, but actually the company is giving you a piece of paper like an IOU for the money they borrowed from you. So it has a stated term, length of time, then the bond will mature, and you get the face value of it. And that will include the agreed upon interest rate. Okay. So on problem number 2, here's a problem where we're going to invest $5,000 in a 10-year corporate bond that pays 7.5% annual interest. So we want to see what's the total return on the investment if it's held to maturity. Now, this one talks about 7.5% annual interest paid semi-annually. So you might be thinking about those problems where we had to divide by 2. But bonds are actually simple interest. Okay. So it's simple interest. So that right there doesn't matter because they're not going to be compounding. So you're just going to take the simple interest formula. So the I equals PRT. So to figure out the interest, you'll take 5,000 times your interest rate, which is annual, times the number of years, and that gives you $3,750. So the total return on your investment, if it's held to maturity, would be $3,750. So you made a profit of, that seems high. I'm gonna work that out. That seems like a lot to earn. I think I might have a decimal place off. So let me just try that again. So 5,000 times 0.075 times 10 years. Nope. So you wind up making $3,750 on that. Pretty good. Can that be? Huh. Anyway, I'm just surprised. All right. And then let's do a little bit with these things called mutual funds. A lot of people have mutual funds, whether they know it or not. Like if you have money that's in a pension in a company that pays a pension, a lot of times they have what are called mutual funds. So it's like not just one stock, but like it's a fund that includes various stocks, might have some bonds and other investments in there. Okay, and we do this a lot of times because it minimizes some of the risk, because you're not just putting everything in all your eggs in one basket. So if some stock winds up not doing so well, you have other investments that'll kind of cover that loss. So this chart just gives you some of the advantages. It's kind of simple. You don't have to figure out how to buy an individual stock. You don't have to have a broker or anything like that. Okay. And then, a lot of times we don't have a lot of money to put into stocks. So we don't get some of the favorable deals. Like if there's a new company that's offering a new issue of a stock, if you're a small investor, you don't get that opportunity. But if you're part of a big mutual fund, you can. And then usually there's somebody that manages it who kind of knows what they're doing. Okay, so that's always a good thing. Now, the impact, the disadvantages, are there can be a lot of charges. Whoever's managing the fund is going to be charging you things. And there's like a broker, then that's kind of deciding what to buy and sell. So they get some money. Okay. And then if something happens, you really don't have cash, right? You just have this piece of paper. Okay. You're also counting on this manager that may not be doing what you were hoping. Like maybe you had a certain risk tolerance and he just went crazy with it. Okay. And then when the person who manages the fund decides to buy or sell, you can incur tax liability as a result. You don't have as much control as an individual. Okay. So again, you just got to weigh those kinds of things. All right. So mutual funds are basically stocks and bonds. Sometimes they even have like real estate components or money market accounts. And so you have more than one stock. So it's not like you just look at that particular company and how much their stocks are worth. You have to consider all the investments. And so what will happen is we'll figure out what the net asset value is of a mutual fund by looking at all of their assets, subtracting all of their liabilities, things they owe, and then we'll divide by the number of shares that they have in that account. So for example, if we wanted to get the net asset value of this particular mutual fund, they have 520 million, so that's 6 zeros, of stock. They also have $700,000 in cash and $300,000 of other assets, maybe bonds. Okay. But they have 4 million in liability. So that's a 4 with 6 zeros. Okay. And they have 30 million shares. So million is 6 zeros tacked on. So this is what I'm going to calculate on my calculator. I'm going to add all that stuff up. That needs to be grouped. If you're going to type that in one step, if you don't put that parenthesis and you just do this, 6, 7. Okay, so let me get it all written out. If you do all this and you just hit divided by 1, 2, 3, 4, 5, 6, okay, and then you just hit divided by 30,000, and you don't have one of those calculators that stacks the fractions one above another, okay, then it's only going to divide 30 million into that last number. You need it to divide on all of them. So this is important. If you're going to type it in one step, you're going to need to have that grouping symbol right here. The top needs to be in parentheses. And if the bottom had more than one term, you would want parentheses there. All right, so try that on your calculator, and you should get as an answer $17.23. So that would be basically what we're saying is that would be the value of one share of that mutual fund. Okay. All right. So now a lot of times we want to be able to compare investments. So we're looking at several possibilities and we want to see and compare one to the other. So that's what's happening in this next chunk. All right, so you can look at how did it do in the past to get an idea of how it might do in the future. all sorts of information online that you can look at if you have the time. Okay. But the most important measure for the performance of an investment is the annual rate of return. Annual rate of return. Okay. All right, so we're looking at in 1 year what was basically the effective annual yield. So this is a formula from an earlier section. I believe it was section 13.1. And we're just using that same formula, but we're normally trying to figure out what would happen. And since it's a mortgage type situation, we typically are paying, or since it's a dividend situation, those normally get paid to you monthly, or your monthly rate for those dividends. All right, so let's see how this all works. So let's look at number 4. You own shares of a mutual fund, and the only return you get is a dividend of 0.5% per month. And then these are going to be reinvested. So that means you're not pulling it out. They're just going to stay there. And that means those are in the account earning money, as time goes on. So we're going to be using this formula since this is the interest rate per month. So the effective annual yield can be found by taking 1 plus the decimal of that, and that's tricky, 0.5%. So you're going to take 0.5 and divide by 100. So it'll be 0.005. And then that's going to be raised to the 12 because it's an effective annual yield. So that would happen 12 times and then subtract 1. So this is the formula we're using, and we're just plugging in that information. Okay. All right, so when you do that, this part right here should turn out to be 1.06168. When you take 1 away from it, you get 0.06168. So this was 1.06168. You take 1 away and you get this 0.06168, which means the effective annual yield in that situation was 6.2%. So you could do that for other investments, and then you could compare the effective annual yield, the annual rate of return. Okay. Now, in this next chunk, these last formulas are dealing with what people typically are trying to save money for. They're trying to save money so when they aren't able to work anymore or when they want to retire, they can have enough money to live on. Okay. So that's what you're trying to do typically, is build some kind of account so you can take care of yourself later. All right, so there's several formulas that we're going to be using for this. So this first one is looking at what the value of the account would be after n years, and it's going to be taking the interest rate, and over here with the I, it's going to be adjusting for inflation. Okay, to kind of see, so you can have a better idea of the buying power of your money down the road. So this is annual deposits are going to be made. You're going to regularly be depositing money into this retirement account, but they're going to be adjusted for inflation. We're going to see what the value of the account would be at the end of n years. All right, so here's the problem we're going to work. We want the final account value. The account pays 8%. All right, so let me get the formula to show. The initial deposit we're making is $2,500. And then after 30 years is what we want to know. And we got 8% for our initial interest rate, the interest rate itself. That's going to be in there for 30 years. But then the formula has this piece where you have to do 1 plus the inflation rate for 30. So you're kind of adjusting for inflation. And then down in the denominator, you take your interest rate minus your inflation rate. Okay, we've got to have that grouping symbol around it like that. So we're just going to plug that in and see. So we wind up getting $426,203.71. So that is, we got some account set up where we're trying to save money. The account pays 8% interest. We're going to be depositing $2,500 and then doing that regular deposit, okay, every year. And when we do, we wind up at the end with about $426,204. Okay. All right. And then just a couple other formulas you might be asked to use. Also look at the final value of an account. All right. So what's going to be happening there? I thought I moved that over. Let me try that again. Okay. All right. So we're going to be looking at two formulas that seem similar. Both of them use the same letters. One of them will be for a tax deferred account where you pay your taxes later. Okay. And then the other one is a taxable account where you pay your taxes up front. So the money, you've already paid taxes on the money before you set up your account. But both of these, the final value takes that into consideration. So it is compared, that you can compare. Okay. Because it assumes that you've paid all the taxes either up front or at the end, and it's giving you the value without those, with that being taken into consideration. Okay. All right. So with the tax deferred one, you got this certain amount you're investing each year. That's the R. And all the contributions, okay, the earnings and everything, they earn a return over the years. And taxes, at which time the tax is going to be paid on all the money in the account. Okay. The final account value is calculated using that formula. So taxes paid after you get your money out. With the taxable account, the taxes are withheld up front. Okay. So the initial deposit is going to be reduced a little bit. And that earnings are also taxed at the end of each year. Okay. But then once you get all your money, it's all through, you won't owe any more taxes. Okay. All right, so it's showing you how to do that. Now let me double check that I have the new formula. Darn it. I think I ran off the correct one for you, but I need to repost it. So this should have an extra parenthesis right here and right here, and it makes a humongous difference. That should have an extra parenthesis in it. So I want to make sure I have that on the one I ran off for you. I corrected it somewhere, but I want to be sure to post the right one. Okay, so we're gonna compare. We're gonna use those two formulas. We're gonna compare tax deferred one. Let me spell that right. Tax deferred versus the taxable product. Okay. All right, so let's go ahead and plug everything in. All right, so for the tax deferred, our value is going to wind up being, that's this formula for the tax deferred. It's going to be the 1 minus tax rate, which we're assuming on this one that they're paying like a 20% in the 20% tax bracket. Okay, the R in this case is $2,500. Okay, then I've got to do the bracket, parenthesis, and then 1 plus the interest rate, which is 0.06. And all of that's going to be raised to the 30th power. And then we're going to subtract 1 according to the formula. And all of that gets divided by little r, which is the 0.06. Okay? And that's the tax deferred. So that's the tax deferred. Okay, let me do that versus, we'll do the other one in blue. All right, so take a moment to type all that in and see if you can get it to work out. Should be $158,116.37. Okay, that's the tax deferred. All right, let me see if I can get some more paper on here. Yeah, okay. So now I'm going to use the formula. Let's do it in blue for the taxable one. All right, so this is the one where my sheet that was posted there was a typo in it that mattered immensely. So I'm going to be putting in the 2,500 where the R is. I'm looking at this formula now. A bracket, a parenthesis, 1 plus 0.06, then 1 minus 0.20. Let me write that better. 1 minus 0.20, close that, and then all of this gets raised to the 30th power. Then I subtract 1 with a bracket, and then all of that is divided by the 0.06. So take a moment to do that. These can be tricky to type in, like we've talked about. So do overkill with your parenthesis and bracket if you're doing it in one step. Close that, raise it to the 30th power, subtract 1, and close that. Divide by 0.06. And I got something different than I did the first time. So I'm going to double check mine. I didn't get what I was supposed to get. I was looking at the wrong one for part of it. All right, so let me try that again. So let me enter it again. So I should do 2,500. Okay. All right, yeah. So then I got $128,403 and about 15 cents. And both of these have, even though one of them's taxable where the money's taxed up front and one of them's tax deferred where the tax is paid later, both of them are considering the taxes getting paid. So it is a true comparison. And so what we find out is that the tax deferred spelling it with 2 F's for some reason. The tax deferred investment turns out to be about $29,000 more. If I just subtract those two, I can see that the tax deferred one is going to wind up being $29,713.22 more at the end of the 30 years. Okay. All right. And that's basically it. So then just work on the homework, and what we'll do in class is spend more time working through problems rather than just talking about stuff.